We are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Property of the Week. I am your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because he's got genius concepts, knows how to generate cash flows. He's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And the star of the show today is a guest investor coming to us from Silicon Valley, where he is a software architect solution evangelist. He has multiple properties around the U.S., a well-seeped and smart guy that we were just starting to like crack open the top on. I can't wait to hear more. Mohan Pateri, welcome to the show, Mohan.
Thank you.
Good to have you here, my friend. And as we like to say, if you want to know about owning homes in your rental property portfolio, you're in the right place. If you want to find out about best in-house property management for rental property investors, you're in the right place. And if you want an edge on the Jacksonville market, you're definitely in the right place. If you want to get personalized attention about those things, go to chatwithjwb.com, book a call, and you're going to spend some quality time with our experts. And right now it is time to welcome the community with the roll call. Mohan, you ready for the roll call?
Yes.
Let's go. All right. Michael Kubata. Hello, everybody. We got Joanna, our community manager, in the house. She says hi. Madison, our marketing teammate, is in the house. She says, welcome to the show, everybody. We got Drew Barnhill. He says, good afternoon. Let's do this. John Henning, good afternoon, all. Lee Bishop, the MVP of the Not Your Average Investor Show communities, in the house. We got Karen Moline, the Duchess of the first family of the Not Your Average Investor Show community. She's in the house. Anthony Ditta from South Florida. Hello, everybody. Leo from California. Good morning, all. Who else we got in here? We got Jen Filson, the fairy godmother of the Not Your Average Investor Show community. Welcome back, Jen. Scrolling through, Ken Moline, the patriarch of the first family of the Not Your Average Investor Show communities, in the house. Who else we got here? Right, scrolling through, we got Bill Shields. Buenas tardes, damas y caballeros. We got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Yes. We got Scott Perloff. Scott, that's a name that I don't recognize. Welcome to the show, my
Scott.
friend.
Scott is one of my best friends from college, and he reached out to me over the last couple of weeks because he just moved to Florida and he's going to be getting into real estate. And I said, you got to come and join the crew here. So Scott, welcome to the show, my friend.
Welcome to the crew, Scott. We got Sergio Prieto, another friend of yours from college, saying Perloff. I'm assuming that he goes by last name in the college days.
Absolutely. All good buddies from college.
And we got Nadeem Shah joining us from the beautiful Pacific Northwest. He is back as well. Welcome, everybody. We are excited to have you here on board. And before we get into the property, we got some breaking news. Greg, what is going on?
You get better and better at that every single week, brother. We do have some breaking news, and it's going to be very pertinent to what we're going to be talking about here on the property of the week. If you have been attending the show for probably the last 2 months, we've been talking a lot about what the Fed's activity has been and how it was very clear to all of us that interest rates are going to be rising and it was going to happen in an aggressive manner. And the breaking news is that is exactly what's happening. So if you look at average long-term interest rates across the country, they have risen about 60 basis points, which is a large amount in a short period of time. And so when that happens, what we do at JWB is we want to prepare all of our investors to be able to hit their return expectations when they put a property under contract. So what that means is on the property of the week that we're going to look at, the expected interest rate for JWB has gone up from 4% interest for conventionally financed to 4.5% interest, the interest rate for conventionally financed. And so this is the value of this community, the value of this show, right? We want to be forward looking and prepare you for how to take advantage in a real estate market that's changing a lot. Well, this is a big change and it's going to continue to happen. We expect to see interest rates going up beyond this. And what this will happen, we'll talk a little bit more, of course, when we get into the property here, but you're going to see cash flows compress. The property you buy today will be more valuable. It will have a higher return on investment than it will that same property you would purchase 6 months or a year down the line simply because of interest rates going up. So a very timely topic. And, I hate to say I told you so, but that's absolutely what we expected. And we expect to see it continue to happen.
Hate to say I told you so, GC, but you've been saying a lot of I told you so's over the last couple of years. I want to tell you, welcome to the show, Noah Randari and Victor Alinas, who just checked in. But right now, let's check in with our guest investor, Mohan. Can you tell us a little bit about you as an investor, right? Like give us a little sneak peek before we test your expertise over here on this property.
Sounds good. So I'm a normal techie here in the Bay Area, San Francisco Bay Area. I had purchased my primary home in 1998, and then 10 years into it, there was a lot of appreciation, and so I was sitting on maybe like 500,000, 600,000 worth of equity, and then I came across this book called "Stop Sitting on Your Assets," where they say, equity in your home is useless if it just sits there. So then I wanted to find a way of find a way of investing that. And so that's when I also took this course by Robert Allen about nothing down. I wanted some kind of real estate expertise, and that course gave me a lot of background on it. Then what I realized is because I had equity in my home, they had this vehicle, the banks had this vehicle called a HELOC, where you're allowed to borrow against your home's equity. And what I did was I borrowed 400,000 from my home's equity. And then based on the knowledge I gained from Robert Allen, I did an analysis of what are the areas that would be good places to invest at that time in 2008, 2009 timeframe. I wanted to look at the places that had the worst or had started falling big time. So it was the time when the real estate crisis was starting, of the big thing in the 2008, 2009 timeframe. And then I found a place close to my home called Tracy Mountain House, where they were a very, very high-end community, which was like selling at 600,000. And after the prices were dropping drastically and literally a 50% drop. So the houses were now selling for 300,000. So I said, okay, maybe this is the place I want to invest in. So I took my HELOC money and make that a down payment on 6 homes. I was like bidding like crazy on homes, and whatever home, I didn't even, sometimes first couple of homes I went and visited them. Then the next 4 of them, I didn't even visit the homes. I was just looking at the photographs and then investing. I bought like 6 homes. The reason being 6 was the magic number, because Fannie, Freddie had limits on maximum number of loans I could take out. So I could take out loans on a maximum of 6 homes. So I put like 30% down on all these homes, and then the remaining was loans. So that's kind of how my journey began. And initially it was scary. The average was 300K when I bought it, but the prices dropped to even 200, 220. So I had like a big churn in my stomach when I saw that, right? But I had to just hang through it. The risk was not only mine, it was also the banks. So that was good to have loans around it. The rents were good. The rents were decent. So I found an agent there who was managing all my properties. So it was not like turnkey like JWB is, but at least they were managing all my properties and collecting rent and stuff like that. And so I did that. Then after 7 or 8 years, I realized that the prices have started going up, and I want to do something called dollar cost averaging. I want to start selling before some other crisis hits. So out of the 6 homes, I was selling 1 or 2 homes every year, starting 2015, 2016. And at that time, I wanted to see, okay, where do I take this money and where do I invest? I don't want to pay taxes on it, right? So I don't want to pay taxes on the gain. I want to defer the taxation, right? So that's when I looked at the 1031 as a means of kind of moving forward. And also one good thing I did, all the money I got from my rents, I never used it for my personal expenses. I reinvested, in the sense that I used it to pay down my loans. So I started paying down loans of 1 home at a time. And then, so the home that is completely paid off, I would sell. So that when I want to buy in the future, I don't want to take a loan, because there's limitations on number of loans you can get and stuff like that. So what I did was, then the home that is completely paid off, I would sell that year. So I sold, and then I was looking around, and that's when I came across JWB, where I needed inventory, I needed good cash flow. I want to move from appreciation. See, there's 2 concepts in real estate, right? There's appreciation, there's cash flow. If there's one is high, sometimes the other one is low. I wanted to move from the appreciation category to the cash flow category. And that's when JWB had a very beautiful turnkey formula. And so I started investing in them. Every time I sell a home in California, I either buy 3 or 4 homes in JWB. And I didn't have any problems with inventory, and they had very good investments. And that's kind of my story. And so now I have 10 homes with JWB. And also I want to diversify a little bit. So I have another 10 homes with REI Nation in Memphis. So that's kind of how, and I also look for states that don't have taxes for real estate investors. So that's my story.
Goodness, there are so many great nuggets right there, Mohan. And I just saw the chat is absolutely loving your story. Jen Philson just said Mohan is a genius. Other people are just loving. You had like 10 or 15 topics. I'm just writing notes down right here of things that are just really important to highlight. I'm going to start at the beginning, which is a concept that not a lot of people, I think, understand, but is really powerful and can really kickstart the ability to start your own rental property portfolio, especially at a time like this where interest rates still are really low. It's the concept of a home equity line of credit. And it's the concept that if you just have equity in your home, while that makes you feel good, your return on equity is zero. What that means is if it's just sitting there, it's not doing anything for you. It's not helping you accomplish your passive income goal, and of course, your life goals that are tied to your passive income goal. And so what I took from you is that you had a lot of equity that was built up. It sounds like this was back pre-crash, back in the day, right? Pre-2008. And you looked at it and you said, okay, well, how can I still hold on to this asset but take advantage of some of the capital, some of the equity that is there? And that's what's called a home equity line of credit. So it is a way to keep the asset, but still access the equity. And then what did you do with that equity? You put it into other cash flow producing investments, right? You created income streams of $3,000, $5,000, maybe $8,000 a month. Whereas $8,000 a month, it's like $100,000 a year that you created for yourself. You wouldn't have been able to do that if you hadn't understood that equity just sitting there does nothing for you. So you turn that into a cash flow stream. I'm really, really proud of you for doing that. I mean, wow, that's really incredible. And I know a lot of folks in the audience can do the same thing. The next thing you did, though, I just think is really courageous, right? Let's go back to 2008, right? Not only did you make the decision to go and invest in other markets that weren't in your backyard, which was so foreign back in the day. Now it's a little bit more accepted. You were a pioneer. It was pretty much like you and me doing that, right? Buying cash flowing assets. You were doing it in places that you didn't live. And then you had to weather that going down in value. You said they went from maybe 300,000 to 200,000, but you continued to hold on. Why'd you do that?
So my expenses were fixed. My rent was also, coming in. So, there's nothing, the value of the home didn't matter. Right. Mostly cash flow positive. Obviously, there are like tenants coming in, moving out. Sometimes you have evictions and stuff like that. Those are, sometimes shocks to the system, but generally, most of the time, these things were rented. And so nothing changed. The value of the house, only when you sell it matters. And when you don't sell, it doesn't matter.
Exactly. That was the same thing that happened to me. I started to build my rental portfolio in 2006. I bought at the absolute wrong time to start buying real estate. And as soon as I bought those 40 rental properties, the value of those rental properties dropped over 35% over the next 3 years. And people are like, weren't you freaking out? Like, what? Did you just sell everything? And I was like, no, because it didn't matter, right? I was planning to hold on to these things for a long time anyways. My cash flows were still strong. It made no sense to sell. It made no sense to worry about it because I had a long-term horizon. That's how you win in real estate. You buy for the long haul. You buy positive cash flow to mitigate your risk, and you give it a full market cycle to play out, and usually you're going to end up performing quite well.
All right. Good breakdown of that initial story. We're going to get deeper into that right around the 1 o'clock hour. For now, let's dive into the property. Let's break some stuff out. If you have questions about the property, make sure that you download it. Go to jwbinventory.com and you can download it. Right now, we are going to magically whisk ourselves away to 2175 Broadway Avenue, Jacksonville, Florida, 32209. Purchase price of $185,000. 3-bedroom, 2-bathroom, 1-car garage. The lease is estimated at $1,195. There's a beautiful picture of this 1-story house here. And by the way, I'm speaking to you on the radio right now. If you're listening, I'm trying to make the best for you to describe it. Best experience is to join us live, nyais.com, and you can join us on your lunch hour. But we love our radio audience. So talking to you right now. And at the end of the day, what investors generally come to is this estimated conventional financing total monthly cash flow of $80 and this estimated conventional financing total ROI of 8.04%. Mohan, you've clearly bought a ton of properties, right? When I flash this thing on screen, first of all, let me know that you can see it clearly. And
Yes.
second, where do your eyes go? What are you looking for on this thing?
I look at the rent and the purchase price, and then we make sure that I get close to a 7% return. Cash return is what I look for, because most of the things. So that's pretty close. So it's pretty typical. So something like a $1,200 rent would kind of get me to close to a 6.8 to 7% cash flow. That's the cash return per year, and that's what I look for.
We do the same thing over and over and over again. We're going to take a look at Mohan's returns here towards the end of the call, and just like he said, the properties that he purchased 1 year ago, 2 years ago, 3 years ago, 4 years ago, had a higher cash purchase total return on investment, right? This one's 5.5%, which we love. It's right into our buy box right now based on the current market dynamics. But like I've been saying in the past, right? As purchase prices go up, your return on your investment comes down, right? So what Mohan was able to purchase a year ago, 2 years ago, 3 years ago at 6.5% returns on that cash purchase return on investment, that same property now is a 5.5% return. And think about what's going to happen over next year and in future years, right? As home prices go up, this 5.5% property that you could purchase today will be a 5% return or whatnot. So that's these same elements of what we're talking about, whether that's just home prices, which would affect a cash purchase, or if we're talking about conventionally financed purchases, right? Then we're talking about home prices and interest rates going the wrong way for you. This is that cap rate compression or that cash flow compression that we're talking about. And you're seeing it right here in this portfolio.
Hey, Greg. And, I can't help but notice that we've been putting on a lot of remodeled properties up on the screen, and you've been talking about how you love a remodeled property these days. What do you love about this property that seems to be a new construction?
Well, and I wanted to make sure that we still showed a few new construction homes here, right? New construction is still a big part of what JWB does. The reality is whenever somebody looks at a home like this, they're like, oh my goodness, this is awesome, right? It's not hard to convince somebody, if you're interested in rental property investing, that a new home is really appealing. But the thing that I love the most about this home, number one, it's available. So we, on the show, for our veterans of the show, in the past, a lot of times homes weren't available. Pablo and I have figured this thing out with our team, and there's a really high probability going forward that the properties you see on the property of the week are going to be available. And this one is, so that's wonderful. And just the reality that you can still get positive cash flow on a new construction investment property. And we've already included the interest rate going up from 4% to 4.5%. You can still get positive cash flow. And that, quite frankly, that's what I love. That thought of getting positive cash flow on an asset like this, new construction in a growth market like Jacksonville, that is not a right. That is a luxury right now. And I hope people really kind of take that to heart, right? Years and years in the past, right? For decades, people have been investing in rental properties, and they never went into it and said, well, geez, I need to get $100 a month of positive cash flow. Just break even was the goal. And that's really where we are going again, when you look at what's happening with home prices and interest rates. And so the way to get positive cash flow right now, obviously, is take advantage of the market where lower prices are lower today, interest rates are lower today. And what you're going to see going forward is people will still get positive cash flow, but they'll have to put more money down to do it, right? So you can put less capital down, still get cash flow. And so that's what I love about this property. You can still do it. It won't be that same way a year from now.
Love it. Love it. And I love that Drew Barnhill's putting, he bought last week's property on the show, right? Like we forgot to mention that last week's property was sold while we were on the show, QVC style, which I thought was really, really cool.
That was a first for us, Drew. That was amazing. And I wanted to give some credit to Anthony Dida as well. I heard you guys were duking it out, and more than anything, I just wanted to say thank you both for your trust. That doesn't happen without a very trusting relationship, and really, really cool story. And I know Anthony picked up his own property as well right after the show. So congratulations to both of you guys.
All right, let's go into a couple of crowd questions here. Lee Bishop asks, it says sewer, but there is a line for water treatment for $200. What is that about?
So that's great pickup there, Lee. So one of the things that we need to do is to make sure that this home is rentable and is going to stay rented and a wonderful resident experience. And, we do the same things in the same neighborhoods over and over and over again. And so we know if there's extra water treatment that we're going to need to do, like a water filtration system or water softener, I mean to say, that is going to be necessary because there's hard water in the area. And so if that's going to be necessary to keep your resident happy and staying in your home to decrease your maintenance cost, we're going to do that as a part of the new build. And then we're going to include any upkeep into your returns, into your return evaluation so that you're prepared so we can overperform over the long run. So it's a long way of saying that's a water softener system. And that's the ongoing maintenance for that. And you're fully prepared and your resident's going to have nice soft water and stay there for many, many years, hopefully.
Great. And patriarch of the first family, Ken Moline, is asking, this house is available, but is it available now or 2 or 4 months in the future?
Great question, Ken. You're amazing, buddy. This is available to put under contract right now. And then what happens is you put it under contract. It is still under construction. Typically, a new construction home will actually be completed 4 to 6 months into the future. And so the closing date, once you actually close on it, will be somewhere, call it 4 to 6 months into the future, which is typical for new construction. But it is available now and you can put it under contract right now.
All right. And we don't have any more questions, but GC, do you want to kind of break down a little bit of the difference between this conventional cash flow versus the ROI and the 5 profit centers in under 3 minutes?
Let's do it. All right. So we have largely been talking about a cash purchase, which is a wonderful way to invest for some folks. For Mohan, it's served him quite well. But if you elect to take on conventional financing, you actually get more access to the profit centers, right? You have slightly more cash flow risk to it, but you have more access to the 5 profit centers. So let's go through what those are, right? Your 5 profit centers are your net rental income, your tax savings, your principal pay down, meaning your resident paying your loan down for you. You've got home price appreciation, and then you've got inflation hedging. And when we're looking at it for a conventionally financed purchase, when your home value goes up, let's say a normal year is around 4.5%, call it 5% to keep the numbers really easy. When you purchase that with conventional financing and you only put 25% down, if the market value goes up 5% that year, but you only put 25% of the deal in your money into it, you can take that 5% appreciation and multiply that times 4. That's your real return on investment from home price appreciation. So if you're in a market like Jacksonville over the past year, which has appreciated between 15 to 20%, and you only put 25% down on your deal, right? That's like 60 to 80% return on investment just from the home price appreciation, right? That is, in a nutshell, why most folks go to conventional financing. Huge upside because you put a smaller part of the deal in your own money. You put less down. And so there we go, right? And Pablo, I'll give you a little update there. That 4.3% number has been updated to 4.6, right? We have data now going back from 1982 all the way to present day. And our average appreciation rate in Jacksonville is actually 4.6% per year. And that's significant. Not just the number, 4.6% is higher than the national average, but the duration of time is significant. Because if you're a follower of the show, right, what we preach is that home price appreciation is largely something you can count on only if you invest for a full market cycle, which is known to be between 15 to 20 years, 10 to 20 years. And the reason that we say that is because if you go back and look from 1982 all the way to present day, and you look at 10-year segments, 15-year segments, 20-year segments of time, the average appreciation rate is right around 4.6%. So what that should dictate to everybody is that if you invest today and you hold on to this property for, call it 20 years, there's a really good chance that your average appreciation rate per year is right around 4.5%. And if you couple that with the ability to use smart debt, you only put 25% down, that's your ability to multiply that 4.5% times 4. What is that, 18% right off the bat?
Yep.
So this, in a nutshell, is why folks take money out of the stock market, diversify out of what the mainly traditional assets are, and come to rental properties. Is because you have risk mitigation, like Mohan talked about, with positive cash flow. And you also have this huge upside, especially if you use conventional financing. And that's why you see this total return on investment jump up to 25% when we put the historically accurate average appreciation rate there down at the bottom.
There you go. Power of leverage. Let's get into your journey then, Mohan. Before you left California and started investing elsewhere, was there any kind of like fear you had to get over? Was there anything kind of holding you back, or was it all pretty matter of fact for you?
So based on my story, you see that I'm a little bit of a risk taker, a calculated risk taker.
Yeah.
So taking a HELOC on your home and buying the downturn takes a lot of, it is risk, right? It is risk. So I realized that California, the cash flow wasn't gonna really cut it. The houses are really high priced for the rents you get, so cash flows are always gonna be low. But appreciation has its own. But I wanted, once I've been in the market for a while, like 7-8 years into California, then I realized, now my equity in these homes were sitting, not earning as much money as they can, and the appreciation beyond a point starts flattening out, right? And so then I said, how can I increase my depreciable basis? My depreciable basis on the houses I had here was the price I bought it for. So now if I sell that, exchange into homes for the full value of the home, my depreciable basis goes up and my cash flow is improving. So those are the factors that made me. And then I looked at JWB and I was pretty convinced by their philosophy. And that's kind of when I said, this is the way to go. I don't want to be a landlord in the sense of a landlord. I want to own properties, but someone else completely manage for. So turnkey was a great, great concept for me.
I think it's really wonderful to hear about your story and know that you have investigated multiple markets out there and multiple providers, and you've landed with us, which we're super grateful for. And you've also landed with a friend of ours, which is REI Nation. We love those guys over there. And I'm curious, in that journey, you chose two of the best companies, of course. What was it like going on that journey? Did you interview other providers out there? Did you go to other markets other than there and make the decision to not go there? Did you see some things with JWB that you didn't see with others? What could you walk through that journey?
Yeah, I also looked at other areas closer to you guys, Orlando, Kissimmee, and other places. They were like a little bit more appreciation and less cash flow. But I didn't see any turnkey providers like you guys. They don't have turnkey providers. You have to just buy a new home and then find a property manager, and that wasn't. It's all about the entire ecosystem. You guys do the whole thing, and the amount of properties you guys manage is crazy. That kind of gives us confidence as investors, right? So that was a huge difference, and nobody else kind of had the entire enchilada.
Mm-hmm. Yeah. It's interesting. In 2006, when I started to invest and as we started to really ramp up the turnkey business model for us, this term turnkey it was just us and our friends at Memphis, or REI Nation now, right? We talked about turnkey properties. We would go into rooms and people would be like, I've never heard of that before. And now 16 years later, that term is morphed into so many different meanings for people because it's really, caught on, that you have a lot of providers out there that say that they are turnkey, yet they never actually buy the asset. They never actually build the asset. They don't actually own it. They don't actually do the property management, but you still look on their website and they're a turnkey provider, right? It's like, it means anything and everything to everybody now, which is tough for the end consumer, right? Because the real value, I'm assuming, make a couple assumptions here, but for you to leave, where you are in your state of California and put your money somewhere else, right? This needed to be passive. This needed to make sure that you had a complete solution rather than a 60% solution or a 70% solution. Am I right on that?
Yes. And let me tell you a funny story. So the other big risk I took was I never even visited you guys. I've never been to Jacksonville, right? I was really scared. One year into it, I referred a friend of mine who wanted to go visit. I said, I have 3 homes there. Can you please go see if it's really there?
Nice.
So it was like, and he sent me pictures. I've seen Google Earth pictures and stuff like that. That's how I know it's really there.
Pablo owns 2. He's never seen them. So you guys are you're in the same boat.
That's right. I live in the same city
anymore either. So there you go.
Yeah. Mohan, let me ask something, man. You've now been in this game for 10 years across multiple markets in many different kind of like delivery mechanisms. What are the hard times, man? What have you had any hard times? Have you had any kind of like hiccups with with JWB or other things, right? Like what should investors know to look out for when things that may or may not happen, and how does it turn out?
Yeah, so obviously during COVID, you would expect a lot of people to lose their jobs, and I was fearing a lot more. I was like, oh, I have 10 properties here, and I had one or two run away, right? But your machine, the JW machine, immediately reacts, right? They say, oh, these people are gone. Okay, this is what we have to do. We have to go fix this, and rent it out. So 1.5 months, 2 months later, it's all rented again, right? You do lose some money in the process. That's also factored into the calculations you guys make. So it's still much less than what the original calculations we really make. So if I look at 10 homes, 1 or 2 homes having that is expected, and particularly in downturn like COVID, right? And so that was what was scary. In California, I had one tenant refused to leave, and eviction and all was a big challenge, right? Not at this time, but later, 5-6 years ago, I lost like $7,000 on that property. But here it is like much faster turnaround. You have a process for evictions, notices, and all that. Boom, it's all like clockwork, and so that gives me a lot of confidence.
It means a lot. Thank you for sharing that. I think Pablo was trying to get a horror story out of you, and all you gave us was a compliment. I mean, I'll take it, but I appreciate
it's a horror story, right? You don't want to lose any money, right? You don't want to lose any money.
Right.
You want all the things to cash flow all the time. But the reality as an investor, you need to be prepared. And you guys, your spreadsheets show that you have a vacancy rate, right? On the vacancy rate. So.
Absolutely. All right, Mohan, what I'm going to do is I'm going to take you through a little bit of a deep dive, a little deeper dive than you normally get with our incredible service team, right? All clients, and Mohan included, get to be a part of the client ROI report, which basically is a really incredible accountability tool, tracking tool for the performance of Mohan's portfolio and all of our clients' portfolio. And you get to see what did we tell you we were going to do when you bought your property with us, and now, almost 5 years later from on, how have we actually performed? And I've done some extra special calculations for you as well, because there's some pretty cool nuggets. So you ready to jump in with me, Mohan?
Sure.
Can you guys see the screen now?
Yeah, we can see it.
All right. And Pablo, please help all of our friends that are listening on the radio and whatnot, help me remember to describe it to them. But for everybody who's in the audience right now. All right. So what we're looking at is Mohan's 10 properties that he's purchased with JWB. And you start to see some similarities, right? You start to see properties that were purchased in 2017, 3 in 2017, 1 in 2018, 1 in 2019, 2 in 2020, and 3 again in 2021. I was trying to correlate this to what you were sharing, Mohan. Was this related to other properties that are being paid off, and then you started to take that money and then purchase another one here in Jacksonville? Is that right?
Yeah, so funny. The way it works is, sold in 2017. I sold a home. I could afford 3 homes in Jacksonville, and JW was my first turnkey provider. Then, so the entire 1031 exchange, kind of has to be more than what I sold in California for, and those 3 add up for that. Mm-hmm. The second year, I did only 1 because I did 2 in Memphis. And then, so like that, you see, and then I did 1 again. I did 2 in Memphis in 2019, but I did only 1 in Memphis and 2 in Jacksonville in 2020.
2020, yeah. So you go in rules of 3, right?
Yeah, rules of 3. 3 or 4 sometimes. Sometimes I can afford 4. But as the prices of the houses here were going up, the prices also in Jacksonville and Memphis were going up. So
yeah. And I see some other things that we hit on here. You have, it looks like, mainly renovations now. There's a couple of, it seems like, new constructions sprinkled in there, but it looks like they're mainly renovations.
The first 3 were new. I think everything else is older.
There we go. So you became more and more comfortable with the thought of something that's not brand new, because at the end of the day, what we see is that the returns on investment over a full market cycle are largely the same. And then the other thing I notice is your purchase prices low, even for 2017, 2018, right? You don't have a purchase price that's higher than 100. Well, you have one at 176. The rest are at 155. I'm sure everybody in the audience and listening right here would be frothing at the mouth to be able to purchase properties at 130, 150,000. One of the reasons I'm sure Mohan went for renovated properties is because they cost less than new construction. And so you get that diversification of more assets in your portfolio, less capital out of pocket. And that's a huge advantage for renovated properties. Is that right?
Yeah, it is. And the funny part is also it's math, right? So if I say divide by 2 or divide by 3 of whatever money I got in California home sale, right? Whatever I could do like 3 125s or 2 like that. So that's kind of where some of the money math comes from as well.
Yep. Make it easy. You just, talk to our team and you're like, okay, I want to pull this amount of money from the sales of the California properties. Or if we're going beyond your portfolio, folks will say, well, I want to pull this amount of money out of the stock market. What type of portfolio can you create for me, JWB? And that's what our team is able to do. Last thing I just noticed here, which is just kind of correlated to your story so far, is you bought all these in cash. And many of them, it seems like, were 1031 exchange properties. All of them are 1031 exchange. Perfect, right? This is a strategy that a lot of folks, right now, it's tough to do 1031 exchanges because many people can't find the inventory quick enough. With a 1031, you have timelines to hit, and it's very tough for people to find the properties to do that. You obviously don't have that problem with JWB. But the next thing is that you have to be able to close loans quickly, right? So like finding the property and then closing the loan quick enough is a challenge, right? Even if it's a new construction property for JWB, if it's going to close 6 months later and you only have 6 months to close on the property for the 1031, it's even a challenge for us. So what a lot of clients will do is they will actually buy those properties in cash to be able to satisfy the requirements for the 1031 exchange, knowing that you get the max tax benefits that way. You can always refinance the property later. So I don't think this was exactly your strategy. You wanted to buy in cash for other reasons, which is great, but just wanted to throw that out there for others. 1031s are still possible with JWB, whereas outside of it, it's really, really challenging. And it may be to your advantage to buy cash initially and then refinance those later on. You still get the same tax benefits. All right. So
Denny brings up a good point here in the Q&A that he's got the 10 properties, right? So that's an added perk, isn't it?
Yes. Great call, Denny. So, and Mon, I hope you're familiar with this, but when you get to 10 properties with JWB, you're a part of our JWB Elite program. So we drop your monthly property management fees from 10% all the way to 8% per month for your management fees. Did that factor into your decision as well?
Absolutely. Absolutely. So the more the cash flow, the better.
Exactly. It saves you probably thousands of dollars a year, there's just a 10% that we would be collecting on the rents that you're earning versus only 8%, right. Which is just incredible. Thank you, Denny, for bringing that one up, my friend. All right, so let's make our move here. So we've taken a look at the overall portfolio. Now let's look at the major key performance indicators. All right, this is how you look at your portfolio in 2 seconds and know how you're performing over the lifetime of your investment. And so for Moan, he's performing at 5.99% lifetime return on investment. All right, he's been investing for 4.6 years. But something that's really interesting here is you start to look at these net rental income numbers and these lifetime total return numbers. Just disclaimer for everybody who may not be familiar with these numbers do not include home price appreciation. These include net rental income, the lifetime total return includes net rental income, tax savings, and any principal pay down. Now, Moan doesn't have principal pay down because he's buying them all cash. So look at this, right? His net rental income is almost $189,000 of net rental income in 4.6 years. Is that pretty great? Should we all just give Moan a big round of applause? 189,000 is what he's used. And they go back to thinking about what he did, right? He started with equity in his home. He accessed that equity in his home to go and buy properties, call it 10 plus years ago, 15 years ago. And because of that, he's created an income stream, which has earned him $189,000 in actual income in his bank account. Is that pretty cool?
I think it's cool, man. You're getting emoji rounds of applause in the chat.
Love that, right? We're not in the same room, but let's give Mon some love here because that's really incredible. The other thing I wanted to point out here is his lifetime total return, $221,000. So the difference between net rental income and his total return, again, is his additional tax savings. So you heard Mohan reference that earlier in the call as well. Being able to depreciate the properties helps you save on taxes, and that continues to add to the return on investment. But, Paulo, I want to ask you this, right? Normally when we see a return of 6%, that's a little bit lower than what we see elsewhere, right? For other clients that we've brought on here. Why do you think that is, Pablo?
I would assume because since he's doing cash, then it's not also including the debt pay down that comes with that, right?
Yeah. Well, when you buy in cash, you put more of your own money down.
Mm-hmm.
And so what you get from that is more cash flow, but your expected return is lower, right? And this fits with Moan's goals, right? What he's doing is he's taking his profits from sales in other parts of the country, and he's converting that to max cash flow in the Jacksonville market and in the Memphis market. And so this fits with his goals. It's a great example of how cash can be a great thing for an investor, right? But what he's getting is max cash flow. What he is giving up is potential additional points of return. And that's a great trade to make for him and with his goals. Did I say that right, Moan?
Yep.
Very cool.
I got another question, Greg. I mean, I'm looking at this slide, and Lee said it in the Q&A, right? Like, is Mohan using this income? Are you using this cash flow as income, or are you reinvesting this cash flow? Because I look at this and I'm seeing this is a whole nother house.
Yeah, no, I'm a single income family. My wife's a teacher. She doesn't make much. So it helped me with my college, paying for college for all my kids and all that. At the same time, I paid down the loans on my California homes.
Makes sense.
It's a beautiful thing, right? It's accomplishing those bigger whys, those bigger reasons for investing, right? Sending kids to college, right? Reducing the debt on your personal home, right? All of those things are wonderful. And it's not always about maximizing your return on investment, right? It's about more than that. You got to work with a team who understands that. All right, Mohan. So here's another little bit of additional digging and diving that I did for your portfolio here. I started to look at your rents, and I was really curious to see what your expected rents were when you signed up and when you chose those properties, and what the actual current monthly rent is now. And the numbers are really, really staggering here. If we start to look, because you have so many darn properties with us, Mohan, I couldn't go property by property. It would have taken up the entire screen and gotten too many numbers. But what I did is I did an average rent per property on your evaluations when you decided to purchase with us. Mm-hmm. It came out to about $1,063 per property. Your actual monthly rent currently is $1,144 per month. That's additional monthly cash flow of $81 per property. And when you add that up, your additional annual cash flow is almost $1,000 on each property, right? Which is just incredible. If I do that same math times 10 properties, that gives you almost $10,000 of an annual additional cash flow that wasn't there in that original evaluation. Can you talk a little bit about that experience and kind of that? I would assume you were pleasantly surprised with your rent rates since investing in the beginning.
Yeah, so one of the things that you factor in is, okay, I expect my rent to increase a little bit over time. But what I pleasantly found is recently, right, one of my homes, Free Avenue, was being rented at $900 a month, and then the tenant moved out. The property values are, as you guys know, in Jacksonville, really, really shot up in the past year and a half. And if I look at it right now as what is the value of this home and what rent should I be getting if I bought it like a new home, it wasn't making sense that I was getting only $900. So I mentioned to the leasing folks, guys, you know what? Are you sure you guys are going to get only $900 again? And so the cool thing that happened is the next renewal, they rented it $1,300. Mm-hmm. A $400 increase. So that's off the charts compared to what we see here. But even this, what we see here is the average over the past 4 years. It's awesome that it's kind of beating inflation. The cash flow is getting better over time because the rents are going up. So it's pretty cool. And so to some extent also the fact that if the house value goes up, the rents also eventually creep up much closer to what the growth of the price of the home is, as well as a big benefit.
And it strikes to the core of why you made this investment. You wanted to maximize your cash flows. That's why you bought it in cash. So this additional $10,000 a year is going to some really great things for you and for your family. We're super, super excited for that. As I always do, Mohan, is I just show the highest lifetime return on investment and the lowest return on investment for your portfolio here. Not too much to mention here other than your highest return. The spread is always going to be a little bit less, right, when you're investing in cash. When you're investing with conventional financing, your spreads will be generally larger, right? That's how financing works, right? The highs are higher, the lows can be lower. For you, your highest lifetime return is 6.89% annualized with an expected return of 5.19. So we're doing about 1.5 points, almost 2 points better there. And your lowest lifetime return is about 3.23%, whereas we were expecting about 5.7, right? So, and you've got 8 other properties that are right in the mix there. So really less volatility, less variability here for this asset class than what you generally find in other asset classes out there. All right. And then last but not least, we wanted to look big picture at all 5 of your profit centers. Wow. The client ROI report is incredible. It helps you see what we are basically controlling, right? The rents, right? The maintenance costs, the property management fees. How are we doing as a provider for you? It is also somewhat limited, right? It's not seeing all of the profit centers. It's not taking into account home price appreciation and inflation hedging. And so I wanted to do a complete overview of really what you've earned if we take that home price appreciation and inflation hedging into account here. For your 5 profit centers, net rental income, we talked about almost $189,000 over the last almost 5 years, an incredible accomplishment. Your tax savings, about 32 grand of tax savings. A lot of investors out there don't even pay attention to the tax savings. You know, right. If you're you or me or Mohan, right? I'm probably paying attention to 32 grand that I've saved compared to other asset classes out there. Now, principal pay down is 0, right? We talked about that. That's the value of your resident paying your loan down. And for Mohan, it's better for him to buy in cash. And so he's not getting that additional profit center of principal pay down, and that's okay. But next, let's go look at home price appreciation. You know, your properties here in the last 4.5, 5 years have appreciated to the tune of over $440,000. How cool is that, Mohan? How does it make you feel?
That's awesome.
That's awesome. And I think it's worth pointing out that when we look at these profit centers, many investors don't pay attention to anything other than cash flow. They don't pay attention to tax savings, principal pay down, home price appreciation, or inflation hedging. But if you look at the overall pie for where his returns on investment are coming from, the majority is coming from home price appreciation. And some may say, well, Greg, that's just because the market went up for the last year or 2 years. But what will actually happen is if you hold this thing constant for the next 10 years, 15, 20 years over a full market cycle, this actually plays itself out very similarly. So we have to open up our eyes to look beyond just cash flow. We have to look at all 5 profit centers when we make those decisions, especially as you're deciding between markets, because some markets are better positioned to be growing at a faster rate than other markets, and that will have a dynamic impact. For inflation hedging, hard to categorize this one. What this means is, of course, as the cost of goods and services go up around you, your rents tend to go up and your home prices tend to go up. So you're seeing some of that, and Mohan's been the beneficiary of that. Just important to note that the consumer price index is what the government used to measure inflation. It's at 7.5%. That's the highest it's been in 40 years, right? Inflation is like a thief. Inflation steals your wealth over time. And so if you are investing in assets that are not tied, that are not hard assets, while you may be making money, you may actually be losing money when you factor in inflation, right? One of the benefits of investing in real estate is that rents go up. Home prices tend to go up in inflationary times. There is absolutely a correlation to that, and Mohan's the beneficiary of that. So congratulations on that. Mohan, anything to add there before I give you your final returns on investment here?
Oh, this is awesome. Yeah, this is actually an added bonus. The appreciation is something I never really took into account. And then, so it's a really big bonus.
You have done quite well, right? And let's be serious, right? This has been the best appreciating time in Jacksonville's history over the last year or two, but let's not take anything away from that, right? You made the decision in 2017 to go down this journey, and you've done quite well for yourself. So here's the big reveal here. When you take all of these 5 profit centers into account and you look at your entire portfolio, Mohan, your expected return on investment for your entire portfolio, those 10 properties with us, was 6.1%. Your actual return on investment is 10.7%, and we're beating expectations. Just want to say congratulations, and we're super, super excited to be serving you for these last 5 years and hopefully for many, many more to come.
Yep. Thanks a lot. It's been an amazing journey.
You got Denny in here. He said it early on. He says, hey, Greg, the last 15 minutes of your Thursday shows are the best you produce in 2022 because of the homework that you do on the guest portfolios. Keep up the great work. And he also put in a request saying that you need to take a 1-year hiatus from JWB and go run Fannie Mae for a year and get them to increase their 10-year loan limit. In Greg, we trust.
Yeah, right. That would be my number one priority. That would help us all out tremendously.
Yeah. Good job by you, buddy. Mohan, great job as the guest investor, man. Thank you for letting us see that story. You know, as the noble fool on this show that gets to just learn from other people, I hadn't gotten a chance to look into a portfolio that was all cash and so like diversified with so many different properties and the effects on that, man. Really eye-opening experience for me. I know that the community got a lot of value out of it. Plenty of people in the chat saying that they want to be you when they grow up. So I think you're doing a great job. And I appreciate you spending some time with us. I appreciate the community hanging out with us. We've been here for over an hour on a Thursday. Never goes, unnoticed that you're taking all this time to hang out with us. That's a tribute to the value that you're putting out there, Mohan, and letting us go through your story and your opinions. And next week, we're kind of in between things. We're working on some big deals. We're either going to have the mayor of Jacksonville on, or Gregg, you got a presentation for us. What's our plan B if we can't get the mayor of Jacksonville on?
Yeah, well, I was just putting a presentation together today. I'll be sharing it with the Fortune Builders community tonight on a coaching call. And the folks were asking me, what's going to happen over the next year in rental property investing? And so it's just an overall look at what's going to be happening next year. And we're going to, of course, talk about interest rates. We're going to, of course, talk about home prices. We're going to do a deep dive and show you guys the metrics that I'm looking at that are guiding these decisions, right? We manage over $750 million of assets for clients like Mohan and Pablo. So we got a big responsibility to know what's coming next over the next year. And so first opportunity is hopefully we get the mayor. Right? We're pretty close. We feel really good about the mayor. We're close. We're close. But if not, then we're going to be doing that deep dive. And I know you guys are going to get a ton of value either way.
Awesome. And Mohan, I'm going to give you an opportunity to speak here. Before I do, I just want to say, if you're listening to us on the radio, you're listening to us on the podcast, join us live on the show. It's as fun as it sounds. The chat is blowing up. People are making friends. We get to ask some great questions. And if you want some personalized attention on how to own rental properties in your portfolio, you want the best property management for rental property investors, or you want an edge on the Jacksonville market, go to chatwithjwb.com, book a call. Mohan, before we give GC the last words here, if you are talking to one of your highly successful children, right? You said you had a doctor and another tech architect in the making, and they're thinking about getting into real estate or getting into rental properties. What's an advice you'd give to a first-time real estate investor on how to go about it based on your amazing experiences that you've had?
Yes, I've been totally privileged that I came across JWB. It has been a true blessing, and I'm really grateful to you guys. And so when my kids say, "Oh, you know what, I'm going to buy this home and keep it here, and you know what, I'm not going to sell it. It's an investment," I say, "No, let's do an analysis. Let's analyze." And turnkey is amazing, and you guys made the word turnkey really, really effective. And that's kind of the beauty, right? And it's a blessing, true blessing for real estate investors, particularly when you're doing 1031 exchanges and things like that, so that you can defer your taxes. It's like, I'm truly, truly, truly happy to have come across you guys, and I hope to continue investing with you guys. Thank you, guys.
I feel the same way, Mon. It's really a pleasure to look at another successful investor who started to invest at roughly the same time I did, who believes the same thing I believe, and to look 15 years down the road and see it being such a successful venture for you, right? Real estate, rental property investing is not buy today, sell tomorrow, make $1 million, right? It's use solid fundamentals, invest with a great team and a great strategy, hold on to it for 15 years and look at how you can change your life. And for you, change the life of your kids, right? Sending them to college and hopefully imparting some of this wisdom and legacy to them as well. So really, really thankful for you sharing your story. More thankful that you put your trust in our team. We never take it for granted. And really appreciate you sharing the story with the audience today. And thank you to everybody. And before we go, I want to say a big thank you to Pablo. Pablo is doing this thing, doing the show Tuesday and Thursday, has been struggling. I want you all to know he is so committed to this community. I tried to tell him to take a break. He won't do it. And Pablo, you bring the fire every time, brother. So I really, really appreciate all you do for the show, man.
Thanks, man. Listen, this is my favorite thing. I rather go down swinging doing my favorite thing, right? So I'm happy to be here. Mohan, this is great. GC, this is great. Community, thank you for the love. I'm pretty sure I'm close to 100%. So on Tuesday, I will stop blaming COVID brain, and I will be just as energetic and as intelligent as I normally am, or I'm not. Until next time. See y'all.
See you.